Our story today starts in Japan. Japan is a unique place for a lot of reasons. They have high-tech toilets that play music, vending machines on every corner, and they gave the world anime. But today, we aren't talking about sushi or samurais. We are focusing on perhaps the most fascinating aspect of Japan, its economy. If you look at the G7 nations, Japan is the odd one out. It is a massive economic outlier, driven by a unique combination of weird demographics, strange corporate structures, and monetary policies that simply don't exist anywhere else. Specifically, we need to talk about the 0% anomaly. For 30 years, Japan has kept interest rates at, or close to, zero. If you are from literally anywhere else in the world, this sounds insane. So, how did we get here? And why does free money in Japan matter to your portfolio? To understand that, we need a history lesson. Part 1. The history lesson. How did Japan break its own economy? It was the perfect storm of 4 specific disasters. Disaster number 1. The bubble burst. Before we watch the bubble pop, we have to ask, who blew it up? It actually started in a hotel in New York in 1985. It was called the Plaza Accord. The US government basically forced Japan to strengthen the yen to help American factories compete. This crushed Japanese exporters like Toyota and Sony. To save them, the Bank of Japan panicked and slashed interest rates to make money cheap. It worked too well. That cheap money flooded the market and ignited the biggest economic party in human history. By the late 1980s, real estate and stock prices were detached from reality. At the peak, the grounds of the Imperial Palace in Tokyo were theoretically worth more than the entire state of California. But in the early 90s, gravity kicked in. The bubble popped violently. The stock market and land values plummeted by 60 to 70%. Banks and companies were left holding assets that were suddenly worthless, but they still owed the debt they used to buy them. Instead of borrowing money to grow, everyone spent the next 20 years just trying to pay off old debt. Economists refer to this painful era of stagnation as the lost decades. The Bank of Japan cut rates to zero to beg people to borrow and spend, but nobody wanted to. Disaster number 2, the deflationary trap. As the bubble burst, demand evaporated, and prices began to fall. Now on the surface, this sounds great. Who doesn't want cheaper stuff? But for an economy, falling prices are actually a nightmare. It creates a psychological trap that freezes consumption. Think about it. If a new Toyota costs 3 million yen today, but you know it will drop to 2.9 million next year, what do? You wait. You don't buy it. But when everyone waits, the engine of the economy stalls. Because people aren't buying, companies make less money. When companies make less money, they cut wages. When wages drop, people spend even less. It is a self-feeding death spiral. To try and break this cycle, Japan kept interest rates at rock bottom. They were effectively trying to make cash trash to force people to spend it now rather than hoarding it for later. Disaster number 3, the demographic collapse. Japan has the oldest population in the world, and here is the harsh economic reality. Old people don't borrow money. Retirees are savers, not spenders. They don't take out massive 30-year mortgages to buy big family homes, and they certainly don't take out risky business loans to launch tech startups. This kills the demand for money. The banks are desperate to lend, but with a shrinking workforce, there is simply no one left to borrow. Low interest rates aren't a strategy here. They are a symptom of an economy that has lost its appetite for capital. If you want to see the physical scar this leaves on a country, just look at the Akiya. These are Japan's ghost homes. There are currently 9 million of them rotting away. You can literally get a house for free in the countryside. But here is the crazy part. Even at the price of zero, nobody wants them. Why? Because the generation of young families that should be buying them simply wasn't born. Disaster number 4, the attack of the zombie companies. Because interest rates were so low for so long, weak companies that should have died simply didn't. We call these zombie companies. In a normal economy, survival of the fittest applies. If you can't pay your debts, you fail, and a better, stronger company takes your place. But in Japan, banks were terrified that if they let these companies fail, the unemployment rate would skyrocket. So they engaged in a practice called evergreening. Think of this like keeping a patient on expensive life support indefinitely. The banks lent these zombies just enough fresh money to pay the interest on their old loans. This kept the patient alive, but comatose. These zombies hoarded workers and resources, dragging down productivity for the entire nation. But here is the scary part. The biggest zombie of all isn't a company. It is the Japanese government itself. Japan has the highest national debt in the developed world, roughly 250% of its GDP. This creates a terrifying trap. If they raise interest rates too high, the government's own interest payments will explode. They could essentially go bankrupt just trying to service their own debt. Part 2. The infinite money glitch. So, that's the history. But how does this affect your portfolio today? Well, hedge funds and big investors love to find opportunities where the math is broken. And Japan's zero-interest policy created one of the most profitable loopholes in modern markets. It's called the carry trade. For decades, this trade has functioned essentially like an infinite money glitch. Here is how it works. Imagine you are an investor standing between two banks. On your left, the Bank of Japan says, "Here, take some money. I will charge you 0% interest." On your right, the US government says, "Hey, if you give me money, I will pay you 5% interest." Do you see the opportunity? It is a simple arbitrage loop. Step 1. The borrow. You borrow 1 billion yen from the Japanese bank. It costs you basically nothing to hold. Step 2. The swap. You sell that yen and buy US dollars. Step 3. The pump. You dump those dollars into US assets, like treasury bonds or tech stocks, that pay you 5% or more. Step 4. The profit. You pocket the difference. As long as the exchange rate between the yen and the dollar stays stable, this is essentially free money. It's a printing press. But there is one massive catch. You are betting the house that the yen stays weak. Part 3. The Great Unwind. But every glitch eventually gets patched. For decades, the carry trade was easy money. But in 2024, the Bank of Japan finally did the unthinkable. They raised interest rates. And on August 5th, 2024, we found out exactly what happens when the free money stops. Markets called it Black Monday. The Bank of Japan raised rates just a tiny bit, to 0.25%. It sounds like nothing, but in the world of leverage, it was an earthquake. The yen spiked, and the carry trade didn't just stop, it exploded. The Japanese stock market crashed 12% in a single day, its worst drop since 1987. The fear index on Wall Street all skyrocketed. Bitcoin tanked. Why? Not because companies were failing, but because hedge funds were hit with a massive margin call. Think of the yen unwind like a massive vacuum cleaner. When the yen gets stronger, those cheap loans suddenly become expensive. Investors panic. They have to pay back the Japanese banks immediately. To pay back the loans, they need cash. To get cash, they have to sell their most profitable liquid assets. And what are the most liquid assets in the world? Bitcoin and US tech stocks like Nvidia. So they sold them, all at once. This is the secret mechanism behind those random market crashes. You wake up, check your phone, and see Bitcoin or the S&P 500 down 5%. But there is no bad news. No scandals, no earnings misses. The companies are fine, but the investors are desperate. They are using your favorite stocks as an ATM to pay off their Japanese debts. Part 4. The strategy. So, where is the opportunity in all this chaos? First, there is the liquidity dip. When the yen spikes, hedge funds are often forced to dump liquid assets like Bitcoin or tech stocks. This creates a scenario where prices drop despite strong company fundamentals, offering a potential discount for the patient observer. Second, there is the currency play. Unhedged Japanese ETFs allow investors to potentially double dip. If the yen rises against the dollar, these funds capture value purely from the currency exchange, turning the volatility into a tailwind. Japan controls a hidden lever of global money. When that lever is pulled, the market often panics. But understanding the mechanics helps us distinguish between a crisis and a sale.